Over 380,000 homes in England were bought through the Help to Buy equity loan scheme since it launched over a decade ago, and a growing number of those homeowners are now discovering exactly what that government loan actually costs them years after they signed, at the exact moment they try to sell, remortgage, or simply understand their own finances properly for the first time. The scheme was marketed as a stepping stone, a helping hand to get first-time buyers onto the ladder when they couldn't quite stretch to a full deposit alone. For a meaningful number of those homeowners, it's become something closer to a financial anchor, quietly limiting their options in ways almost nobody explained clearly at the point of signing. In the next few minutes, I'm going to walk you through the truth about Help to Buy, where those homeowners actually are now, and the specific mechanics of the scheme that are catching people out years after they thought the hard part was already behind them. I've been tracking the UK property market for years, and Help to Buy is one of those schemes that looked straightforwardly positive in the headlines when it launched and has turned out to be considerably more complicated in practice for a significant share of the people who used it. Let's get into it. It's worth being clear from the outset that Help to Buy wasn't one static scheme running unchanged for its entire life. It went through several iterations, different equity loan percentages, different eligibility rules, different regional caps over the years it was active before it eventually closed to new applicants. That evolution matters because it means the exact terms a homeowner is dealing with today can vary meaningfully depending on precisely when they bought, which version of the scheme they used, and which region they bought in. London's enhanced 40% equity loan option in particular created a distinct set of dynamics compared to the standard 20% version used across the rest of England. Anyone trying to understand their own position should start by confirming exactly which version of the scheme applies to their specific purchase, rather than assuming the terms are identical to whatever version a friend or neighbour might have used. Here's how the scheme actually worked, because understanding the mechanics properly is essential to understanding why so many homeowners are now in a difficult position. Help to Buy allowed first-time buyers purchasing a new-build home to put down a deposit of just 5%, with the government providing an equity loan of up to 20% of the property's value, 40% in London, interest-free for the first 5 years. The buyer then needed only a standard mortgage to cover the remaining percentage, dramatically lowering the barrier to entry compared to a conventional purchase requiring a full deposit. On paper, this looked like an elegant solution to the deposit problem covered extensively elsewhere on this channel. In practice, the structure of that equity loan has created a specific set of problems that are only now becoming widely understood years into homeowners' experience with the scheme. The first problem is that the equity loan isn't a fixed sum, it's a percentage stake in the property's value, which means if your property's value rises, the amount you owe the government rises in exact proportion, not just the original loan amount. A homeowner who borrowed a 20% equity loan on a property valued at £250,000 borrowed £50,000. If that property is now worth £320,000, they don't still owe £50,000, they owe 20% of the current value, £64,000, an increase of £14,000 in loan value without the homeowner ever spending or receiving that money. This isn't a hidden trick, it's disclosed in the scheme's own literature, but a meaningful number of buyers, focused primarily on getting onto the property ladder in the first place, didn't fully absorb the implication at the time that rising house prices, normally good news for a homeowner's equity, simultaneously increase what they owe back to the government on the same property. This creates a genuinely counterintuitive emotional experience for many homeowners. Ordinarily, rising property values are unambiguously good news. More equity, more borrowing power, a stronger financial position. For a Help to Buy homeowner, rising values are a mixed blessing at best. Their own share of the property's value does grow, but so does the government's in exact lockstep, which means the homeowner captures a meaningfully smaller proportion of the total gain than they might intuitively expect when they see their local property market rising in the news. The second problem lands at the 5-year mark when the interest-free period ends. From year 6 onward, homeowners start paying interest on the equity loan, beginning at 1.75% of the loan's value in the first year of charges and rising annually thereafter in line with inflation plus an additional fixed percentage compounding over time in a way many homeowners didn't fully model out when they first signed up for the scheme as a first-time buyer in their 20s. There's an additional wrinkle worth explaining clearly here. The interest rate charged isn't fixed at that initial 1.75% figure. It rises each subsequent year in line with the retail price index measure of inflation, plus an additional fixed percentage on top, which means in periods of higher inflation, the annual increase in what homeowners owe in interest can accelerate considerably faster than they might have anticipated when they first read the scheme's literature during a period of much lower, more stable inflation. The third problem, and this is the one causing the most difficulty for homeowners trying to move on with their lives, is what happens when you want to sell, remortgage, or simply pay off the equity loan early. Because the loan is a percentage stake rather than a fixed sum, repaying it requires a formal RICS qualified valuation of the property at the time of repayment, a process that takes time and costs money, and the repayment amount is based on that valuation, whatever it turns out to be, not on the original purchase price. Homeowners in areas where new build prices have grown quickly find themselves needing to hand back a considerably larger sum than they might have expected, purely because their specific new build development's value happened to rise faster than the wider market. Something that's been particularly pronounced in some of the postcodes covered in earlier videos on this channel, where new build oversupply has actually pushed some values down rather than up, creating the opposite problem: homeowners whose equity loan repayment is smaller than expected, but whose overall equity position is squeezed regardless, because a falling property value combined with a percentage-based government loan still owed on top erodes the actual proceeds available to the homeowner after both the mortgage and the equity loan are repaid. Take a specific example of how this plays out. A homeowner who bought a new build flat for £220,000 with a 20% equity loan of £44,000 discovers when they come to sell 8 years later that the RICS valuation now places the property at £280,000, an increase that feels from the homeowner's own perspective like a genuinely good outcome for their investment. But the equity loan repayment is now 20% of that new figure, £56,000, meaning £12,000 more than the original amount borrowed simply flows to the government as part of the sale, money the homeowner never had access to at any point, but which nonetheless reduces exactly what they walk away with to put toward their next purchase. The fourth problem is remortgaging with an active equity loan still in place. Some mainstream lenders are considerably more cautious about remortgaging a property with a Help to Buy equity loan still attached, because the government's charge sits on the property alongside the mortgage, and not every lender's underwriting criteria comfortably accommodates that structure. Homeowners approaching the end of a fixed mortgage rate, exactly the situation covered in an earlier video on this channel, sometimes discover that their remortgaging options are narrower than a homeowner without an equity loan attached, precisely at the moment they most need flexibility to find a competitive new rate. Specialist brokers who work specifically with Help to Buy homeowners describe this as a genuinely common source of frustration. A homeowner assumes remortgaging will work the same way it would for any other property, only to discover partway through the application process that their chosen lender either doesn't offer products compatible with an active equity loan at all, or offers a meaningfully narrower range of rates than they'd have access to without one, effectively limiting their negotiating power at precisely the point their fixed deal is ending, and the standard variable rate trap, covered in an earlier video on this channel, starts to loom. The fifth problem is that staircasing, the official term for gradually buying back portions of the equity loan to reduce the government stake, is neither cheap nor simple. Each staircasing transaction requires its own formal valuation, its own set of legal and administrative fees, and must typically be done in minimum increments, often 10% of the property's current value, rather than smaller, more manageable chunks that might better fit a homeowner's actual savings pattern. A homeowner wanting to buy back just a small slice of the government stake each year, as their finances allow, generally can't. The system is structured around larger, less frequent staircasing transactions, each with its own repeated cost, which discourages the kind of gradual, opportunistic paying down that might otherwise make the most financial sense for many homeowners. There's also a timing dimension worth naming directly. A homeowner considering staircasing has to weigh the cost of a formal valuation against the benefit of reducing their equity loan. And if property values in their area have risen significantly since purchase, staircasing becomes considerably more expensive, precisely because they'd now be buying back a percentage of a larger current value, not the original purchase price, which means the ideal time to staircase from a pure cost perspective was often earlier than most homeowners realized, before values had risen as much as they eventually did. Now here's what connects all 5 of these problems, and it's the part that almost nobody explained clearly when the scheme was actively encouraging people to sign up. Help to Buy was marketed, understandably, around its immediate benefit, getting first-time buyers onto the ladder with a smaller deposit than they'd otherwise need. That immediate benefit is real and shouldn't be dismissed. It genuinely allowed hundreds of thousands of people to become homeowners years earlier than they otherwise could have. But every one of the 5 problems above stems from the same underlying feature of the scheme. The government's stake is proportional, not fixed, and that single design choice, reasonable from the government's own perspective as a way to share in future property value growth in exchange for providing the initial support, quietly transformed a straightforward seeming loan into something that behaves more like a silent equity partnership, one where the partner's share of any gain grows automatically and where exiting that partnership requires formal valuations, minimum transaction sizes, and fees that most first-time buyers focused entirely on getting through their very first purchase simply weren't thinking about at the time. This is worth stating plainly because it's easy in hindsight to characterize the scheme as either purely good or purely bad, when the more accurate description is that it solved a genuine immediate problem, the deposit barrier, while creating a genuine deferred problem, the proportional repayment structure, and the vast majority of homeowners who used the scheme experienced the immediate benefit clearly and understood the deferred cost only vaguely, if at all, at the point of signing, which is precisely the information gap this video is trying to close.
Here's what nobody puts together properly. The homeowners most affected by these problems tend to be exactly the same demographic the scheme was specifically designed to help. People who didn't have significant family wealth or savings behind them when they bought. Precisely the buyers covered in an earlier video on this channel who are increasingly locked out of the market entirely without some form of assistance. Help to Buy gave that group a route in, but the specific structure of that route means the same buyers who most needed help with their initial deposit are also, on average, the ones with the least additional capital available years later to comfortably absorb a rising equity loan value, a new interest charge, or the cost of an early staircasing transaction. Creating a scheme that solved the entry problem for a specific group while quietly building in a second, later problem for that same group to eventually confront. It's worth stating this connection directly because it's easy to miss when the 5 problems are considered individually rather than together. A buyer who genuinely needed a lower deposit barrier because they lack savings or family support is almost by definition less likely to have a large financial buffer sitting ready 5, 8, or 10 years later to comfortably absorb a rising equity loan, a new interest charge, or the cost of an early staircasing transaction. The scheme's target demographic and the scheme's later financial demands are, in a meaningful sense, working against each other, not through any deliberate design flaw, but simply because the same underlying financial constraint that made the scheme necessary in the first place doesn't disappear the moment the initial purchase completes. Here's how this plays out for homeowners who haven't planned around it. They reach year 5 with little awareness that interest charges are about to begin, and the first bill arrives as an unwelcome surprise on top of an already tight household budget. They try to remortgage as their fixed rate ends, only to discover their options are narrower than they expected because of the equity loan still attached. They eventually try to sell and are surprised by exactly how much of their sale proceeds go toward repaying a government stake that's grown considerably since they first borrowed it, sometimes leaving them with meaningfully less to put toward their next property than they'd budgeted for. Precisely the same buyers who 10 years earlier needed Help to Buy because they didn't have much of a cushion to begin with. There's a specific compounding pattern worth naming in this scenario too. Homeowners who are surprised by the interest charges at year 5 are often the same homeowners least equipped to simply absorb the extra cost by cutting back elsewhere, precisely because their household budget was already built around minimal slack when they first qualified for the scheme, which means an unplanned few £100s a year in new interest charges can represent a genuinely meaningful strain rather than a minor adjustment.
Here's how this plays out for homeowners who do plan around it properly. They mark their 5-year anniversary date clearly and start budgeting for interest charges well in advance, rather than being surprised when the first bill arrives. They get an independent, up-to-date sense of their property's current value periodically, so the scale of their equity loan liability isn't a mystery that only gets revealed at the point of a formal, costly valuation. They research staircasing rules specific to their situation early, understanding the minimum increments and associated associated costs before deciding whether a partial buyback makes financial sense for their specific circumstances, rather than assuming it will automatically be the obviously right move. And when planning a sale or remortgage, they factor in the cost and time required for an RICS valuation and equity loan repayment well before they need to move, rather than discovering the process part way through an already time-pressured transaction. Here's how this plays out at the wider level over the next several years. Expect a growing wave of Help to Buy homeowners reaching their 5-year interest charge milestone each year, given how the scheme's usage built up over its active years, meaning this isn't a one-off cohort experiencing this shock, but a rolling wave that will continue for some years yet, as successive years of buyers each reach their own 5-year mark in turn. Expect continued public and campaign group attention on the scheme's structure, particularly around the proportional repayment mechanism, as more homeowners share their experiences of exactly how much their equity loan grew relative to what they originally expected. And expect mortgage lenders' underwriting approaches to Help to Buy properties to keep evolving, potentially easing as the scheme becomes more familiar and better understood across the lending industry, or potentially tightening further if the sector sees a rise in problem cases, either direction of which will meaningfully affect existing homeowners' remortgaging options going forward. There's also a policy dimension worth watching over this same period. As the true scale of the interest charge and repayment issues becomes more widely understood and more publicly discussed, expect increasing pressure on government to consider some form of transitional support or restructuring option for existing Help to Buy homeowners specifically, separate from any decisions about future first-time buyer schemes, though the practical shape and likelihood of any such intervention remains genuinely uncertain at this stage.
If you bought through Help to Buy, the single most valuable thing you can do right now is understand exactly where you sit relative to the mechanics described in this video. Check your exact interest-free period end date, and don't wait for the notification to plan around the cost. Get a realistic, independent sense of your current property value periodically, rather than being surprised by a formal valuation only when you need one for a specific transaction. Understand your specific staircasing options and their associated costs well before you might actually want to use them. And if you're approaching a remortgage or sale, start that process earlier than you would for a property without an equity loan attached, because every one of the 5 problems in this video takes longer to navigate than homeowners typically expect, precisely because the scheme's proportional structure adds a layer of complexity that a standard mortgage simply doesn't have. It's also worth having a genuinely honest conversation with an independent mortgage broker who has specific experience with Help to Buy properties, rather than assuming your existing lender or estate agent will proactively flag every relevant consideration, because as covered elsewhere on this channel, the incentives of those parties don't always align perfectly with giving you the fullest possible picture before you commit to a specific course of action. Help to Buy did exactly what it was designed to do for hundreds of thousands of people: get them onto the property ladder years earlier than they otherwise could have managed. That achievement is real and shouldn't be lost in this conversation, but the scheme's proportional loan structure means that achievement came with a second chapter most homeowners weren't fully prepared for when they signed on the dotted line. And understanding that second chapter properly, ideally well before you reach it, is the difference between a scheme that quietly helped you and one that quietly complicates your finances for years after the initial purchase is long since forgotten, buried somewhere in a filing cabinet alongside paperwork nobody expected to need to revisit so many years later.